This price move doesn't end where the last ones did. Gold and silver are climbing while officials keep saying stability is returning. That's the contradiction. Markets are repricing risk while the message says nothing's wrong. And this matters to you because it decides whether prices ever come back down or whether this level is the starting line. Since 2020, the money supply expanded by roughly 40%. That's not a cycle, that's a reset. When the number of currency units explodes that fast, assets don't cool off, they re-anchor at higher levels. Notice what they didn't deny: no one is promising a return to old prices. Here's where the story flips. Previous spikes collapsed because the system stayed intact. This time the system is straining, debt markets, trade and supply chains all at once. Now watch how fast this escalates. Buried inside the silver market is a signal that doesn't look speculative at all. It looks structural. A gap between paper prices and physical reality that can't be closed quickly no matter what headlines say. And once you see what's actually driving this move, it becomes very hard to believe this is temporary. The core event isn't just that silver and gold are rising. It's how they're rising and what's happening underneath. This move isn't coming from a single shock or a sudden rush of speculation. It's forming inside a system that's been quietly changing for years. On the surface, prices are pushing through levels that used to act like ceilings. But underneath, the drivers look very different from past cycles. In earlier spikes, supply eventually responded, confidence returned, and prices rolled over. This time, supply was never prepared to respond in the first place. Years of low prices discouraged investment, exploration slowed, and production shifted toward byproduct mining instead of primary supply. That matters more than most people realize. Here's the question that reframes everything. What happens when rising prices meet a system that physically can't scale fast enough to meet demand? Not next quarter, not next year, at all. Notice what's missing from the mainstream discussion. There's very little talk about whether enough metal actually exists at these prices, and even less about how long it would take to fix that gap if it doesn't. This is where the story stops being about markets and starts being about constraints. The claim sounds extreme, but the evidence is already there. This isn't a speculative squeeze, it's a supply problem that was years in the making. Roughly 75% of global silver production now comes from byproduct mining. That means silver isn't mined because prices rise. It's mined only if lead zinc or copper projects happen to be profitable. And here's the concrete detail that changes how you see this. Ore grades in many operations are struggling to reach 100 grams per ton. In plain terms, miners are moving more rock than ever to get less metal than before. Compare that to the outliers. In places like the Golden Triangle in British Columbia, discoveries showing 467 grams per ton over 15 meters stand out precisely because they are rare. Those numbers aren't the norm, they're the exception. And they highlight how scarce high-grade silver has become. Now notice what's missing. There's no wave of new primary silver mines coming online, no fast pipeline of replacement supply. The easy silver was already pulled out of the ground when prices were low and incentives were gone. This is where the signal shifts. Silver isn't being stockpiled like gold, it's being consumed. Electronics, energy systems, industrial uses, once it's used, it's gone. And that changes the math completely. This is where the pressure starts to compound. When supply can't respond, markets don't stabilize, they stretch. And historically, when that happens, something else breaks first. In the late 1970s, silver surged on speculation and collapsed when the corner failed. But that system had slack. Central banks still had room. Debt levels were lower, trade flows were stable. Today looks nothing like that. Instead of one distorted market, you have several moving at once. Bond yields are jumping in places that are supposed to be calm. Debt-heavy governments are trapped between inflation and solvency. And at the same time, industrial demand for silver isn't slowing. It's becoming non-negotiable. Solar panels don't wait for price corrections. Electronics don't redesign overnight. Here's why that matters. What used to be temporary spikes are now becoming normalized prices. Levels that once felt extreme are holding. Each pullback is shallower. Each rebound is faster. That's not hype. That's stress being absorbed instead of released. But here's the part nobody is saying out loud. When normalization sets in, volatility doesn't disappear. It relocates. It moves upstream into finance, logistics, and policy. And once it gets there, the timeline accelerates. The second proof is more unsettling because it exposes a contradiction between price signals and real-world behavior. On paper, silver is in a bull market, but at the physical level, the system is seizing up. Coin shops and local dealers are being flooded with sellers at the same time prices are rising. To survive, many dealers have abruptly widened their spreads, moving from buying $5 under spot to $10 under spot almost overnight. That's not confidence, that's liquidity stress. Here's the concrete detail that matters. Dealers aren't lowering prices because silver is losing value. They're doing it because they can't move inventory fast enough to get cash back. They're over-leveraged with metal and undercapitalized with cash. And that's forcing defensive behavior across the retail market. Now notice what doesn't line up. If this were a normal speculative blow-off, liquidity would be abundant. Buyers would step in, spreads would tighten. Instead, exit doors are narrowing even as the headline price climbs. This gets more serious upstream. Major refiners have started rejecting non-pure silver entirely 90% coinage sterling alloyed scrap. Some are offering buybacks as low as $15 under spot. Others are simply saying no. This is where perception breaks. A rising price paired with collapsing liquidity isn't a healthy market. It's a bottleneck. And once bottlenecks form, pressure doesn't dissipate. It transfers. Now the stress starts stacking fast. First, retail liquidity dries up, dealers widen spreads just to stay alive. Then refiners choke the pipeline by refusing scrap and alloyed silver. At the same time, spot prices keep rising, sending mixed signals that confuse everyone watching from the outside. But here's the escalation most people miss. While Western retail markets are jammed, pricing pressure isn't easing globally. It's relocating. Physical silver that can move is being pulled out of weak hands and pushed towards stronger demand centers. The system isn't calming down, it's fragmenting. Add another layer. Industrial buyers don't participate in this chaos the way retail does. They don't wait for dips, they don't care about dealer spreads. They buy because production lines don't stop. That creates a split market, one side panicking over liquidity, the other quietly absorbing supply. Now watch how fast this compounds. Retail sellers feel trapped, dealers feel squeezed, refiners shut doors, and industrial demand keeps pulling metal forward. This isn't a crash setup, it's a pressure cooker. So ask the only question that matters now: what happens if this continues? At this point, the story stops being abstract and starts hitting daily life. Because when markets jam like this, the consequences don't stay on trading screens, they land on ordinary people. If you've ever tried to sell something valuable during a volatile moment, you already recognize the feeling. Prices say one thing, reality says another. You're told the asset is worth more, but when you try to exit, the door is narrower than you expected. That's what's happening now. Retail holders are discovering that liquidity isn't guaranteed. Just because a chart is going up, coin shops hesitate. Buyback offers come in far below spot, and suddenly timing matters more than value, not because silver failed, but because the system around it is under strain. Zoom out, and this touches more than metals. It affects borrowing costs, product prices, and job stability in industries that rely on predictable inputs. When raw materials become volatile, those costs move downstream. Quietly at first, then all at once. This is how financial stress shows up in real life, not as headlines, but as friction. Delays, higher prices, fewer options. If this feels familiar, say so in the comments, because what's happening here isn't isolated. It's a pattern and it's spreading. What allows this to keep happening isn't chaos, it's structure. The system is built to prioritize flow over stability. When stress appears, it doesn't stop activity, it redirects it. Financial markets keep trading, governments keep issuing debt, industries keep demanding inputs, and instead of resolving shortages, the system papers over them with leverage, delay, and narrative. Here's the unsettling insight. Price discovery no longer happens where the pressure is highest. It happens where friction is lowest. Paper markets absorb volatility. Physical markets absorb scarcity. And policy sits in between, smoothing headlines while pressure builds underneath. That's why you can see rising prices alongside falling liquidity. The incentives reward continuation, not correction. No one is paid to slow things down. Central banks are incentivized to stabilize debt markets. Governments are incentivized to maintain growth optics. Industries are incentivized to secure supply at almost any price. So the stress doesn't release, it migrates. This is why mainstream coverage keeps missing the signal. They're watching sentiment while the mechanism runs automatically. And once systems like this pass a certain threshold, they don't reverse cleanly. They lurch forward until something forces a reset. That reset doesn't announce itself ahead of time. It arrives when momentum outruns control. From here, the path forward splits, but neither option looks calm. One path assumes pressure stays contained. Markets keep absorbing stress through higher prices. Paper volatility masks physical scarcity. Governments step in quietly, adjusting rules, classifications, and funding to keep supply moving. In this version, nothing breaks on camera. Prices simply keep drifting higher, punctuated by sharp pullbacks that reset sentiment but not structure. The other path is faster and messier. A shock hits a weak link, debt markets, trade flows, or currency stability, and forces decisions that can't be delayed. Liquidity vanishes where it's needed most. Intervention becomes visible instead of subtle, and price doesn't rise gradually. It gaps. Notice the uncertainty isn't about direction, it's about speed. Both paths point the same way, but the timeline changes everything. Slow pressure reshapes behavior, fast pressure reshapes systems. And here's the key detail. The next move isn't waiting for a headline. It's forming inside balance sheets, policy meetings, and supply contracts right now. You won't know which path we're on until it's already underway. Here's the insight that ties all of this together. This isn't a story about silver getting expensive. It's a story about systems losing the ability to pretend price is temporary. When money expands faster than supply and supply can't respond, the adjustment doesn't reverse. It settles at a higher level and rewrites expectations. That's why this moment feels different, not louder, different. The signals aren't coming from hype or panic. They're coming from constraints, incentives, and quiet policy shifts that don't make headlines until it's too late to act early. Once markets accept a new baseline, they stop arguing with it, they build around it, and by the time that happens, the old reference points no longer matter. This is the layer most coverage never reaches, where price becomes a consequence, not a cause. If you want to stay ahead of how this unfolds, not react after the fact, follow and subscribe for continued analysis. Because the next phase of this story isn't about whether things change, it's about how fast.